What up? It's your boy, 3 videos a week. Asterisk mark. Today's video is a question that I get asked all the time, and I'm not exactly certified in this, so take my word with a grain of salt, but I have been through the ringer a couple times, so hopefully I can spread that information on to you. And that question is, what should I invest in? Now, in order to keep this video's topic evergreen, as they call it, I'm not going to recommend any sort of individual stocks, which you shouldn't be investing in anyways, or in any sort of specific funds as a whole, like any REITs or anything like that. Of course, everything that I mentioned here will be just as profitable as it is now as it will be in 20 years. So this video has got some legs. Today I'm bringing you 3 different vehicles to invest in, starting from the most risky to still kind of risky, but you know, exactly not one of those things that you don't exactly talk about, and it's still pretty good, but it's still kind of risky, you know what I mean? Yeah, totally, that's what iPitch Always is all about. Yeah. These all carry some sort of inherent risk. So if you're somebody who's about to retire in like 2 weeks, I would invest in some more safe stuff like bonds and everything. But if you're young and you're like 15 to age 30, maybe even 40, these are definitely some good ideas that you can definitely put some money towards. And my analytics show that most of y'all are like young, so yeah, I think we'll be fine with a little bit of risk. So like every investor worth their $1,000 stocks course, I'm going to go ahead and give you what everybody says up front. And that is, the best thing that you can invest in is yourself. It's a meme, it's an axiom, it's one of those things that get beaten to the ground over and over and over and over, but it's very true. If you were to go to school and get $60,000 of debt, but you walk away and you make about $50,000 a year, you'll definitely be making some better returns overall compared to putting that money in some sort of fund that only gives you about, you know, roughly 4% a year, and that's being conservative. But my big thing is, if you're going to take any loans, read back to front what that entails and what you're going to be looking like when you're going to be exiting your school, as well as learning any sort of marketable skills within your field. This is stuff like crisis management if you're a nurse. This is project management if you're some sort of web developer or coder as a whole. And of course, customer service if you're a gender studies major. I'm sorry, everybody makes fun of you, and I don't want to be another one of those, but I had to get the big 3, you know, and I'm sorry, but we all have that. Look, accounting isn't exactly all it's cracked up to be. With that, let's jump into it. But first, hit that like button. That way you can have access to all this premium content. I lied, it's actually all free, but here we go. So the first and most risky thing I can always recommend that somebody invests in is opening their own business. Now this is the only one that actually is nothing to do with the stock market, but I wanted to make sure I covered something that is very risky, but also some very good returns. I don't need to tell you that businesses make money. That's pretty much the whole point of having one. That or paying for advertisement that can say literally whatever you want. Businesses, of course, are risky. Everybody knows that. But according to the Small Business Association, roughly 80% of all startups fail within their very first year. That's like 4 out of 5. Like 9 out of 10 dentists recommend that, but 4 out of 5 businesses will fail. Ooh. But even the worst and most likely case scenario where you have to go back to working a 9 to 5, you're going to have some really good experience under your belt, such as management, marketing, and product development, as well as some other stuff, just depending on whatever business you actually find yourself in. And again, businesses make a lot of money, and they're really easy to start up, especially if you're in America. But don't you dare make another t-shirt company. My God, do we not need another one of those? You know why. If you could find a problem and you can solve it, you are already a huge step ahead of the game. And if you run into problems while trying to solve that first problem, you can open a separate business to take care of that problem for both you and everyone else down the line. That's how you do it. Now on to the actual big stuff to invest in if you don't have the time or sanity to maintain a business, and that would be a mid-cap growth index fund. Trading stocks is basically throwing money at a roulette wheel. You never know exactly what's going to happen, and despite how much the boomer wisdom may course through your brain and seep through your cells and every fiber of your being, you're not going to be able to predict the market. If you were to invest at the highest of highs at all the time, you still would not be able to beat out a good consistent growth strategy. A mid-cap growth is literally the chaotic neutral as far as the alignment chart goes for any sort of investment vehicle. You've got great consistent returns on a well-diversified portfolio of companies that's not as slow as the biggest, but also not as risky as the smallest. So you got yourself the best of both worlds, while also getting your toes in some businesses that may end up being some household names in the near future. I know these are fingers, but I mean, look, like if people are taking pictures of toes, aren't these pretty much just long toes? Phalanges, am I right? That's liberal arts education. Looking at the portfolio that is managed by Vanguard, if you were to put $10,000 in 2010 back in this portfolio that they have, you would be worth $40,000 by 2020. Not exactly a big cash money, dollar, I get what you get in 10 years and 2 days money, but it's definitely something that is reliable, it's consistent, and it's pretty much guaranteed if you just, hold yourself to it and put a portion of your paycheck into it month after month. And again, I've talked about this plenty of times before, but in case you don't know, if you own an index fund, you own a wide variety of stock. It goes with the classic, why buy one stock when you can have many? That's how it works. I mean, that's literally all it takes to be a great investor, is just have your hand as many honeypots as possible. That's what it takes. What sucks is that most of these mid-cap growth index funds are actively managed, which means that there is some boomer up in his boomer tower able to foresee what stocks to take in and out of the index fund. So you do have to pay a little bit of a commission fee for that, and some management fees as well. But it's very reliable, it's very strong, and again, wouldn't you rather have somebody who at least has a better idea than you going at it? Hey, just a suggestion. You could also invest in mid-cap value and as well as anything else along the alignment chart, but mid-cap growth has been proven time and time again, consistently, at least to me, to be a very valuable vehicle to invest in. And the third and least risky is another index fund, but that is going to be a total market index fund. Again, why buy one stock when you can have many, when you can have all? Yeah, it's caveman logic, but honestly, most things kind of work that way. Everybody got a lizard brain, y'all. Fun fact, you know how they say a room full of chimps on typewriters will recreate Shakespeare? Well, a portfolio full of every stock will beat every trader, ever. Over a long-term basis, even the most wizened of boomers is gonna get their calls wrong, and they're gonna get something on the downturn or just gonna get defaulted on altogether. But if you go for a total market index fund, generally the market increases year after year after year, very consistently and in a very strong upward trend. So if you just ride that wave without having to pay anything extra along the way, just take that bus all the way from Brownsville, Texas, all the way up to Utica, New York, and you don't have to pay for any bus fares along the way, you got yourself a very long, very leisurely, and possibly a very comfortable ride. Most total market index funds are literally just throwing crap on the wall, so nobody's managing that. It's covering everything. If you buy everything in the S&P 500, you got yourself everything in the S&P 500. You don't have to pay a high schooler to manage that for you. You could just buy everything, case closed. And it's something just to look at for the very, very long term. This is something that you will put money in consistently from when you're 20 all the way up to when you're 60, and you'll be able to make a pretty darn comfortable living off of that. The only thing I can really say that's a negative amongst these funds is that if you were to take your money out during an economic downturn, not exactly the best thing to do. Also, it's kind of boring. Everybody wants to be that Wolf of Wall Street, where you're just going out throwing money on midget hookers and throwing them against a dartboard there. But I mean, honestly, if you're just to take it slow and steady, put $200 a month towards it, you'll end up with some crazy good cash by the end of it. It's just not exactly dirty blow and hookers money. It's just some good, modest, Christian, wholesome, nice, celibate, maybe Islamic too, could be conservative, Mormon, milquetoast, boring, dry, yeasty. Good time. And that's gonna do it. Those are the three main things I always recommend that somebody invests in. Again, don't do this if you are merely making it by. Try to find some way to get some extra funds along the way. Chop off whatever you don't need, throw it to the fire. You don't exactly need to be spending $30 a month on Netflix. But if you have yourself to where you have an extra 200, 300, 400 plus whatever, money that you're not exactly doing anything crazy with, I really recommend putting into one of these, especially if it's something that you won't miss it if you need it. I know that's a rare thing to say and it's such a privileged thing, but if you find a point where you don't exactly need $200 a month, I would recommend tossing it in there instead of tossing it in your bank account, because you will by far and by average get better rates of return overall. Thank you so much for watching. Please again hit that like button. Check me out on Instagram. What? That's right. Yo boy is making almost daily videos on there. I'm not exactly 100% sure what I'm gonna do with it, but I definitely want to be doing some stuff on Insta. I want to diversify. You know, I talked about diversified portfolios on here. Well, let's just diversify content. Anyways, you probably already clicked off. Thank you so much for watching. Hope you have a great day. I'll see you soon. Okay, if it's just the cool people, like everybody who's been around for a while, I'm gonna go ahead and give you a little bit of a heads up. The reason why I've been posting a little bit is because I've been working on a monster of a video. This thing has taken me 10 days, raw animation work, just over and over and over. It's a lot of work, but I hope you look forward to it. It's a little bit more edgier than my kind of stuff, so if you're somebody who doesn't enjoy edgy content, I'm gonna go ahead and give you the advisor now, but it's about OnlyFans. It's about all the scams that happen with OnlyFans. Ooh, I hope this is going to be worth all the effort. Okay, with that, thank you so much for watching. I'll catch you around.